The long Marubozu red candle is one of the most bearish candlestick patterns, indicating complete dominance by sellers in the market. With no upper or lower shadows, the candle opens at the high and closes at the low, signifying relentless downward pressure throughout the trading session. The absence of shadows highlights that there were no significant attempts by buyers to reverse the downward trend. This pattern reflects an aggressive bearish sentiment and is often a strong signal for a continuation of a downward trend or the beginning of a new bearish phase. The long red candle is a bearish pattern characterized by a close significantly lower than the open, but with small upper and lower shadows. Unlike the Marubozu, this candle suggests there was some level of buying and selling activity during the session, though bears remained firmly in control. It reflects a weaker bearish sentiment compared to the Marubozu, but still indicates a strong down day. This candle often signifies a continuation of the downtrend and is closely watched by traders for further bearish confirmation. The long opening Bozu red candle starts with a high open, similar to the Marubozu, but ends with a close near the low, leaving a short lower shadow. This pattern signifies a day dominated by bears, though some buying support emerges near the close. While it is less bearish than the long Marubozu red candle due to the presence of a lower shadow, it still signals bearish market sentiment. This candle often appears in downtrends, confirming continued bearish pressure. The long closing Bozu red candle opens near the high and closes exactly at the low, leaving a short upper shadow. This pattern reflects initial bullish attempts that were quickly overpowered by bears, leading to a close at the lowest point of the session. The long closing Bozu is nearly as bearish as the long Marubozu red candle and often signifies a strong bearish continuation. Its presence signals that sellers are firmly in control, with no support from buyers towards the end of the session. The short red candle is a bearish pattern with a small real body and short upper and lower shadows, forming during a day of below-average trading range. It reflects weak bearish sentiment as the close is lower than the open, but the small size of the candle indicates limited momentum. This candle often appears in consolidation patterns or during pauses in a trend. While bearish, it lacks the strength of longer red candles, making it less significant as an isolated pattern. The red spinning top is a neutral candle pattern characterized by a small real body and long upper and lower shadows. The open and close prices are close to each other, indicating indecision in the market. This pattern reflects a tug-of-war between bulls and bears, with no clear winner by the session's end. Found in a trending market, it can signal a continuation or reversal depending on its location. If observed after a strong rally, it may suggest a bearish reversal, while after a decline, it could indicate a bullish reversal. The red lower shadow candle features a real body larger than its lower shadow, with the close below the open. This pattern indicates that while buyers stepped in to provide some support, sellers ultimately maintained control, leading to a bearish close. It often appears in consolidation phases or as part of a continuation of the prevailing trend. Though weak compared to other bearish patterns, its lower shadow suggests some level of buyer interest, which could limit its bearish implications. The red upper shadow candle shows a real body larger than its upper shadow, with the close below the open. The presence of an upper shadow indicates an attempt by bulls to push prices higher during the session, but bears ultimately regained control and closed the session at a lower price. This pattern is more bearish than the red lower shadow candle because it demonstrates a failure by bulls to maintain their gains, reinforcing bearish sentiment. It can signal a continuation of a downtrend or the persistence of selling pressure. The inverted red umbrella candle, marked by a small real body and a long upper shadow, represents a potential reversal in the market. The upper shadow must be at least twice the length of the real body, suggesting strong selling pressure after an attempt to push prices higher. Found at the top of an uptrend, it is termed a shooting star, while at the bottom of a downtrend, it is known as an inverted hammer. The significance of this candle lies in its location on the chart, indicating either a reversal or a continuation depending on the trend context. The red umbrella candle has a small real body with a long lower shadow, indicating significant buying pressure after the market initially fell. The lower shadow must be at least twice the size of the real body. This candle is called a hammer when it appears at the bottom of a downtrend, signaling a potential reversal, or a hanging man at the top of an uptrend, warning of potential bearish reversal. The interpretation of this candle depends on its position, as it can suggest the beginning of a shift in market sentiment.